Hello, everyone. Kia ora koutou, and welcome to the Stewardship Masterclass on System Stewardship. Thank you all very much, everyone, for joining us. I am Jackson Rowland, the Director of the Aotearoa New Zealand Stewardship Code, which is a framework that guides investors on how to use their influence to support the companies they invest in to navigate long-term risks and opportunities. For today's masterclass, the first 30 minutes are being recorded and will be shared publicly. After that, we'll then move into a signatory-only Chatham House conversation. So signatories, please stick around for that second half. Today, we're exploring systemic stewardship, one of the more important evolutions in stewardship practice. I'm going to leave our speakers today to explain what system stewardship is, but I just want to note that we're seeing a significant increase in the focus on system stewardship, both globally and here in New Zealand. And this is a really great development in investment practice. But it's also another thing to do, requiring more resource, so investors rightly want confidence that they're doing it well. And that's what today's about, practical takeaways to make systemic stewardship effective. To do that, we've brought together leading international and domestic voices to explore what this looks like in practice, and there's going to be plenty of time for questions in the second half. To get us started, I'm delighted to hand over to Jess Brown, co-founder of the Action Exchange. Jess is ideally placed to guide this conversation. Through her work at the Action Exchange, she's engaged deeply with a wide range of systemic issues. And, importantly, she's brought together diverse stakeholders to actually influence them. That ability to convene different players around system-level challenges is exactly what today's topic is about. So I can't think of a better person to steer us through it. And with that, I'll hand over to Jess. Thanks, Jess.
Thanks so much, Jackson. And hello, everybody. Thanks for joining us today. I want to begin with one proposition, and that is that systemic stewardship is fundamentally a coordination challenge. The risks that we're going to discuss today don't sit neatly within the control of any single investor or company or policymaker. They're shaped by the interaction between markets, regulation, industry practice, and collective behaviour. So the work, therefore, in systemic stewardship is not just to identify a problem or articulate a position. It's really to understand who has influence, where incentives diverge, what is preventing action, and how enough actors can be brought into alignment. Now, much of this work is out in the world of policy, in the commercial world, working with NGOs, engaging in the wider public debate. But perhaps an even bigger part of it is working internally, to be a voice for this kind of thinking within the organisation and spreading this kind of thinking and practice laterally across the organisation. Engaging investment teams, not just sustainable investment teams, is probably the most difficult part, but perhaps where the most important task lies. Now, building alignment is not the same as achieving consensus. Investors, asset managers, companies, governments, standard setters, the public, they all often have very different priorities and they have different mandates. Effective stewardship is really finding the points at which those interests can intersect and finding alignment to support a credible direction of travel. Today's discussion is going to focus on what that looks like in practice, how investors decide where they can work within that system to add value, how they can work through others, and how they can turn their individual stewardship activities into broader system-level progress. To help us do this, I'm very pleased to introduce our three guest speakers. Laura Hillis is Managing Director of Responsible Investment for the Church of England Pensions Board, and Laura is a sustainable finance expert with more than 15 years working in finance and capital markets on issues such as climate change, nature, and human rights. Bill Burckart is CEO of the Investment Integration Project, which focuses on integrating system-level thinking into investment decisions. And Sue Walker is Senior Manager of Responsible Investment at Harbour Asset Management, where she leads the delivery of responsible investment strategy and policy, including the development of stewardship programs and meeting regulatory obligations. Welcome to our panel. Bill, I'd like to start with you. Can you just begin by telling us, what is system stewardship, and what does the investment, how are leading investors approaching stewardship in a systemic sense?
Yeah, so broadly defined, so system stewardship and related concepts like system level investing really are about the intentional using investment to intentionally manage the overarching societal, environmental, and financial systems that underpin long-term value creation and general progress, like societal progress. When you kind of get below that headline, they're building on a lot of the traditional asset management and conventional investment tools that many investors are already familiar with. And they're bringing to bear a bunch of advanced techniques that really stress, to your point, things like collaborative action, building shared knowledge bases, setting industry standards, and ultimately collaborating to create a kind of rising tide of opportunities for all investors. And importantly, they're doing that by focusing on these kind of key leverage points that strengthen overall societal, environmental, and financial systems. And we see that kind of play out differently for different kinds of investors. And so in the US, you have something like Westpath Benefits and Investments, pension fund manager. And for them, they really have focused on this idea of moving in from a stewardship perspective, moving from company by company engagement to really thinking about engaging entire value chains, engaging their managers, engaging policy. So really broadening the aperture of what it means to do stewardship. You have others like HESTA, the Labor Fund in Australia, that really focuses on this idea of the power of collective action. And so even in their responsible investment policy, they really call attention to the fact that collaboration with their peers is kind of essential to driving this kind of action. And they really make this point, particularly when you don't forget about that systems part of it, where they connect those dots between like housing affordability and how that can affect their members' retirement security and workforce retention and economic productivity. And so they're really thinking about the interconnection of these issues. You have others like in Japan, where Nippon Life Insurance, where they really focus on this idea of guardrails. So investor-defined internal boundaries that ensure investment activities do not undermine the vitality of these big systems. And they apply that consistently across their investment process from asset allocation to stewardship. And then they think about this idea of standard shaping. So really extending one's own investment actions to influence industries, markets, and policy frameworks, essentially elevating common roles and expectations. And so all of that feeds into this bigger idea of norm setting across capital markets in the system. So just from like a high level flavor, that's how some of these investors are taking that idea of system stewardship and then essentially translating that into some of their practices.
Thanks, William. And Laura, one of those investors that is thinking about this and doing this is Church of England Pensions Board, which is one of the leading investors in a global sense in this. I mean, how are you thinking practically? How do we translate these big concepts into something that practically at the portfolio level, how you think about systemic risk and stewardship?
Thanks, Jess, and it's lovely to be here. I think Bill explained the concepts of kind of how we think about this and the definition, and that kind of joined up thinking really, really well. But maybe I'll provide a few examples. So firstly, the Pensions Board is a relatively small pension fund, I would say. So we have about £3.4 billion in assets under management and about 44,000 beneficiaries. And we do exactly what it sounds like we do. We look after the pension for people who've worked for the Church of England and based in the UK. Don't let my accent deceive you. So really, we've had a really long-standing approach to this, partly, I think, because of the fact we're a faith-based investor, and there was kind of a need for us to really think about how our beneficiaries wanted us to act with regards to their pension. But I don't think that the faith-based thing necessarily precludes other investors from thinking in this way. In fact, I think if you actually talk to beneficiaries and understand their interests, you find really common things across lots of different pension beneficiaries. And we certainly see this when we talk to other pension funds in the UK. Their beneficiaries kind of want them to be thinking about these issues, but fundamentally, they also want them to be thinking about the long term, particularly, you know, in terms of their retirement income. So that's really where I guess the impetus and the support for this comes about. And how we've been doing it in practice, I mean, I could go into a number of different examples, but I think what we've done well, and I think we're still kind of learning the lessons and iterating, has been bringing investors together to address specific issues. And as Bill said, sort of mapping out the whole issue, understanding where it impacts us, understanding where it impacts other investors, and trying to bring kind of all of the actors together to address it. And so this is quite a distinct approach to just doing kind of stewardship through company engagement. And I'll provide an example about how this actually differs in the way we do stewardship in practice. So we in-house in-house our stewardship. We do all of our own voting across our public equity portfolio. But when we select a new responsible investment theme, so we're focused at the moment on food systems, energy systems, the mining sector, and also conflict. And when we did portfolio analysis to try and identify which companies we wanted to engage with, we didn't focus on it from a materiality perspective. Like, we really don't care how much we own in a particular company. We care what role they're playing in the global ecosystem when it comes to the issues that we think are going to affect the portfolio long term. So that means fundamentally, even if a company is relatively small in our portfolio, but we think it plays a really outsized role in, say, the mining system or the food system, they would still form part of those kind of feedback loops that we set up when we're looking at an issue. And just to provide a bit of an example, just one that's a very live example at the moment. So maybe 5 or 6 years ago, we started working on the issue of corporate lobbying because we were concerned that one of the biggest blockers to climate action globally was the fact that companies are consistently going to policymakers and delaying and diluting climate policy. And so we wanted to create more transparency around this and felt that we had a role as shareholders in doing that. So we teamed up with some other investors and developed something called the Global Standard on Responsible Climate Lobbying, which is exactly what it sounds like. It's a disclosure standard that we ask companies to disclose to. So we launched that in 2022. It became part of Climate Action 100 Plus and a few other kind of key benchmarks that companies get assessed against in terms of their transition plans. It also became part of the transition plan task force set up by the UK government. So there was a few different ways we kind of hooked it into other processes. But right now, at the moment, there's been a lot of lobbying going on in the EU to try and water down the EU emissions trading scheme, which is one of the biggest and really most successful climate policies ever. And unfortunately, the EU Commission is now looking at actually weakening the ETS quite a bit, which is a shame. So what we're doing at the moment is we are kind of doing that feedback loop. We're talking to companies and asking them to disclose their positions on the ETS, asking them to disclose what they're doing with their industry associations. If they have a more positive approach, what we see as like a more productive, progressive approach on thinking about lobbying, we ask them to be really public about that. And at the same time, we're going in directly talking to policymakers ourselves, and we're also getting other investors in rooms to try and upskill them and work together to try and address this issue. So it's that whole kind of thinking about the whole system.
Wow, that's great. And a lot of work seems to be going on. So over to you. Let's talk about what's happening in New Zealand. And can you tell us, it's a much smaller market, obviously. What does that look like? What does systemic stewardship look like from a New Zealand perspective?
Kia ora, everybody. Thanks, Jess. Yeah, so I think for us at Harbour especially, but we participate with a lot of other investors in different groups, is it's definitely something that's building. I think, there's been a lot of collaboration in response to regulatory standard changes, policy, that sort of thing. And certainly when climate disclosures came in, I think it was a fairly all-consuming thematic in New Zealand to, talk about the impact of the disclosures, how we kind of responded to some of the things that were being asked of us. However, having said that, that we're starting to see, sort of move away from that regulation and disclosure consultation to start thinking about some things that are important for New Zealand. So often that can be to do with KiwiSaver, which is our similar to the Australian superannuation or the English pension schemes. But, also on things like human rights and conflict. And a lot of those things have been driven from our investor or our clients, of what's important to them. So as you mentioned, it's a small market, and I think it's probably fair to say that at Harbour we have a responsible investment team of 2 people, and I think that's one of the larger teams in the market. So we do have to prioritise, can't do everything. So for us, it is climate still remains a big theme, human rights, and especially dealing with human rights in conflict areas, and probably around getting things like data and understanding, what companies are involved in those areas. So we've done a bit of work through RIA with some of the third-party data providers on getting that data that we need for that. We we absolutely use our industry groups like RIA, like the Stewardship Code, the Centre for Sustainable Finance here in New Zealand a lot for collaboration and for working on those kind of more systemic stewardship issues. I think probably one of the good examples for that was all the investors got involved last year in signing a letter that went to government on the Modern Slavery Act, and that we didn't, I think Rachel's on the call, so Harbour didn't drive that, but we were certainly participated in it, and there were a large number of investors that joined that letter, and it's now, a Modern Slavery Act is now working its way through Parliament in New Zealand. So we like to think that we had a small part to play in getting that done. So I guess, yeah, we definitely have to prioritise. We have to be, I guess, we have to think about how we're engaging and who we're talking to. So the industry groups have been really beneficial in that respect within New Zealand. And then there are some things that we'll think about what we're doing as a business, what's sitting, the risks that are sitting within our portfolio, and we'll prioritise. I think it's fair to say that probably 2 to 3 kind of systemic themes would be the most that we could cope with at any given time with such a small team.
And Bill, systemic risks are often described as non-diversifiable. So how does that change how you think about the stewardship role of institutional investors? What does that mean?
Yeah. So that powerful word, diversification. So that is the tool that most investors normally rely on to manage risk, right? So you spread capital across enough uncorrelated bets, and idiosyncratic risk essentially voids out, it washes out. So when you think of these big systemic risks, though, if you think of climate, financial system stability, global pandemics, they essentially break that logic because they hit the whole portfolio at once. And the whole idea, there's nowhere to hide from climate change. It's hitting every sector. It's hitting every industry. So what that ultimately does is it changes stewardship in those kind of concrete ways. So engagement replaces exit as the primary lever. If a risk is fundamentally undiversifiable, selling a stock just moves the exposure to another holding in the same universal portfolio. It doesn't reduce total risk. So the rational response for a large, broadly diversified investor, so in the case of Laura, you think of a pension, faith-based investor, you think of sovereign wealth funds, you think of index managers, is to essentially try to reshape that system itself. And they do that through some of the things that Sue was saying, Laura was saying, proxy voting, engagement, collaborative initiatives, supporting better disclosure and regulation. Second big thing is it reframes whose interests you're ultimately serving. So it broadens that from the classic stewardship lens of, all right, we're just going to focus on single company value maximization. When you bring in the systemic risk angle and you kind of adhere to some of those universal owner type principles, because you're holding a whole slice of the entire economy, you now have to match or balance that kind of company value maximization with aggregate economy-wide value. And both those things have to be optimized, but you have to now consider both. And then the final thing that it shifts is essentially around time horizon and metrics. So if you think about systemic risks are compound and are often slow moving until they are absolutely not, and then they are sudden. So stewardship essentially has to weight long duration, tail risk mitigation more heavily than it would for idiosyncratic or diversifiable risks. So that's essentially when you think of diversification and how it shifts from portfolio level stewardship to systemic stewardship, those are some of the key variables that factor into it.
This is quite a different way of thinking and to what a lot of investors and asset managers are used to. So Laura, how do you manage that? How do you get asset managers to take these systemic risks seriously and think about them as drivers of portfolio returns?
Yeah, there's probably a couple of different angles that we think about when we think about the investment teams that we deal with, whether they're kind of our in-house team or the asset managers that we work with. So when it comes to our manager appointment process, we make sure that responsible investment considerations are through the whole process. One thing I'd say about asset manager appointment, though, and just ongoing kind of monitoring and relationship management with asset managers, is systems stewardship is a really hard thing to evaluate from the outside. And I would say that often the quantitative measures that we're really comfortable with using when it comes to evaluating kind of other metrics that we would ask asset managers to report on often don't work so well, because very rarely can you say, we're focused on this issue and we took these actions and therefore the issue shifted and we can attribute that to us. Like, it's just not likely when you're dealing with these really big issues. And so what we've found is that asking asset managers, either when they're kind of pitching for a mandate with us or when we're doing our ongoing evaluation process, providing a combination of more quantitative, so actually kind of looking at just outputs, really, how many meetings, how many submissions, so those types of kind of really basic data points, but also with lots of case studies and more qualitative information. And we found that if you can have conversations with people who are actually doing the work, you can actually get a really good feel for if what they're doing is actually truly kind of systems level work. And part of the way you can tell is people end up having really weird stories to tell you. So they'll be telling you about a really specific conversation they had with a particular person in the Ministry of Finance in Jakarta. And then it'll be, they had this conversation with this company and they learnt this weird thing about the biofuel that they're using, that they're putting into, it's all of that kind of stuff. And I think when you can have those really detailed conversations with asset managers, you get a really good sense that they're actually doing this work. In terms of the, I guess that the way that it works for us, we outsource all of our asset management. So that is kind of where the investment decisions are made for us. But we manage our own strategic asset allocation in-house. And so I have an investment team that work on that side of things and manage our managers, if you like. And so getting the buy-in from them is also really, really important. But I think the thing that we've done really well with our team is, I think, partly building the case. So we do that in a couple of different ways. One is, as I mentioned before, the beneficiary input. The second thing is using our industry associations, like Sue said. I think that's a really important one to kind of build the evidence base. The third one is we often do kind of scenarios with our investment team and our investment committee and our trustees, which really helps to kind of get people to understand how these risks are, I guess, cascading and kind of what the second order impacts look like and how the work that we're doing addresses those. So that's all really helpful. And then the last thing that I would say is it's also quite structural. So my team is, I think there's about 18 of us at the moment in the investment team for the pensions board, and it's an even split, which everyone hates me when I say this, but it's about an even split between responsible investment and investment staff, which is very unusual to have that kind of resource internally. We know how lucky we are. But that integration of having the same team, we have a co-head structure where we have a CIO and a CRIO, and they run the team equally. So there's kind of a real sense of an integrated team. That has made a really big difference, I think, in our ability to be effective, because what it means fundamentally is day to day, when we're talking to managers, when we're making investment decisions, when we're working on things like we're doing a sustainability solutions project at the moment to look at assessing sustainability solutions in the portfolio. When we're doing all of those sorts of things, we're doing it kind of hand in hand with the investments team, and because we are one team, so it doesn't feel like so we don't really have the same issue that I think some people have in different parts of the investment sector where, they feel like they're kind of having to knock on the investments team's door a little bit. So we're quite lucky with that. And I think with, to go back to the manager piece, over time, we have found that we have moved to having more and more managers that have a really clear alignment with us on these issues. I think partly that has just happened kind of naturally as opposed to it happening kind of really intentionally. But we are finding increasingly that we're partnering more and more with managers on stewardship, or partnering with them on policy engagement, or partnering with them on different systemic initiatives. And that has worked out to be a really good model for us as well, not least because we kind of get a really good sense of what the kind of questions that they're asking in engagements and the kind of quality of stewardship that they're providing as well, which is really helpful. Sorry, I jumped around a little bit there, but hopefully that
No, that's
sense.
great. And I think it's a really interesting example. And I'm sure a lot of people are listening to that with, quite a lot of envy, thinking, it's quite an unusual arrangement, I think, to have the responsible investment team have such prominence. And I would imagine, and Sue, I want to go to you here, because I would imagine that that is quite unusual, and for for a lot of responsible investment managers and stewardship teams, actually it's really trying to do that internal engagement with the investment teams where there's a lot of work. I mean, how does this kind of translate for you and for what you see in the New Zealand context?
Yeah, and look, we might be small, but we're the responsible investment team are part of the overall investment team at Harbour, and we do have some really good, we're very integrated and have some good dialogue with the rest of the investment team, which works really well. So I mean, it's part of our role to look at what's happening in the external market, those kind of big emerging themes and issues that could impact the portfolio or the broader market, and we have regular catch-ups and talk through exactly that. So you're right. I think that internal engagement is really important, and that also helps us with our prioritisation and where we should focus. So it's really good to get their perspective, or the investment team's perspective, on that. I guess we also use external managers. So I was really interested in what Laura was saying, and I think at the very beginning, Laura, you were talking about it's a hard thing to measure, but having those conversations, you can usually tell pretty quickly how much they're doing, and I've certainly found that I'll start asking questions about usually trying to explore what's happening in the offshore markets that they're seeing versus New Zealand. So talking about, are they getting a lot of questions about, human rights issues in conflict areas? And, the silence often can tell you quite a lot. So that, we spend a lot of time with external managers, but we also, part of that kind of due diligence when we're taking them on is, very much around what they're doing and that kind of policy and systemic level issues. Climate's obviously been a big part of that. And we've definitely chosen managers. Like, one of our managers is just very much involved in the energy transition. That's kind of one of their big investing themes. So we certainly are looking at how they're thinking about those big themes. And I mean, I think the other thing I'll say, and I think Laura probably touched on this a little bit as well, is that I see the kind of systemic level and the company level engagement is very much interconnected. So a lot of the things that we're talking to companies about is on those big themes that are important to us in New Zealand.
Fantastic. And as always, this is going, we could stay here all day, but we're rapidly moving through time. So this brings us to the end of the recorded session, which will be going online. So to everyone who's watched the first part of this session, thank you so much for joining us, and we hope you found it interesting. We will let you drop off now, and we'll continue on to transition to the signatory only portion of this masterclass. So